One of the biggest reasons to get into real estate for tax purposes is depreciation. Hi, I'm Bette Hochberger, CPA, CGMA. This channel covers tax strategies and preparation, real estate finance, and more. Come learn how to grow your business and keep your wealth. We are here to talk about maximizing some of those real estate tax savings. Love dealing with real estate. What I hate dealing with is people missing out on tax savings. Because why? You're just giving your money to the government for no reason. So, a couple of things to maximize your real estate tax savings. The number one thing that drives me crazy, like absolutely batty crazy, that I don't understand is people with rental properties who don't claim depreciation. Why? It blows my mind. It's one of the biggest reasons to get into real estate for tax purposes is depreciation. So why aren't you claiming it, right? Now, I will say depreciation is not the easiest thing in the world to calculate. It is complicated. For example, you don't get to depreciate your land, the land portion of your building. It's just the building. So you might need a CPA, tax person, somebody who knows the ropes to help you figure out what the depreciation is. But that doesn't mean if you can't figure it out that you shouldn't take it, right? You should go consult with a CPA to do that calculation for you to make sure you get to take advantage of it. Plus, those fees to the CPA to help you determine and calculate your depreciation will also be a write-off related to your real estate property. So beyond just the depreciation, I would say what I often see is a lack of record keeping is really bad for your taxes for your rental property. So calculate your depreciation and keep track of everything, all the expenses. Make sure that you are claiming every deduction that you are entitled to. It's probably one of the biggest. Now, if you are buying and selling real estate properties, you're going to want to look at 1031 exchanges. 1031 exchanges let you swap properties, and they don't have to be like exactly the same thing, but it's selling one piece of real estate and buying another. And the reason it's such a big deal is because you are deferring the capital gains on that transaction, on the sale, down the line, right? So normally if you sell something like a piece of real estate and you get your bunch of cash from the sale, you're going to have to pay a big chunk as a capital gains tax. This kind of, I don't want to say eliminates it, but you're kicking that tax can down the line, right? So you're eliminating it for right now, and it becomes later use problem. It is actually possible to 1031 through properties so many times that it becomes part of your estate. And if that last property, if you die while you own it and you've 1031'd your way through all of those properties, all those years, you might defer the entire capital gain away. It's amazing. It sounds like cheating. Hopefully it takes a long time before you can take advantage of that, but it is a strategy. It's a tax strategy. It's an estate planning strategy. And if you know you're going to buy a new property, I beg you, please look at it. See if you can do a 1031. It's not an easy calculation. It's not an easy situation, but it's definitely one that you can take advantage of to save yourself a ton of taxes. Cost segregation studies. There's a little bit here. It's a little bit in depth, right? Cost segregation studies, what it is for those who don't know, is when you buy a house or any kind of rental property, right? You're not just buying the building. You're buying the roof, you're buying the appliances, you're buying the window fixtures, the floors, the kitchen counters, you're buying all of these elements, right? And if you do a cost segregation study, we can actually break down the price of the property that you bought into its various component pieces. Why would you want to do that, you ask? So once you're breaking it down into its component pieces, you're going to have different asset classes. For example, like your appliances, those would be what we call a 5-year asset, right? You might have land improvements, whatever they had to do to the land to prepare it to put the building on it, 15-year asset class. The building itself might be 27.5 or 39% not percent, year assets, but all of these are subject to different types of depreciation. Now, why is this exciting? Well, those 5 and 15-year assets are eligible for bonus depreciation, which means you can take a whole buttload of that depreciation right now, like in that first year. So that can be super, super powerful in the right condition. Now, this isn't great for everybody, but it's something that it's worth looking at, because if it's good for you, it could be really good for you. We use this a lot with our short-term loophole clients. I like to call it peaking the peak. You're going to get a really big bang for your literal buck when it comes to your taxes, because you can take a lot of depreciation in that first year when it's a non-passive rental activity, and you can offset other income. So that one is fantastic. Qualified business income deduction. Now, this one, again, it's not gonna be for everybody. Not everyone can take this, but if you have rental properties and it rises to the level of being a trade or business, you could be eligible for the qualified business income deduction, right? Now, this has a lot of rules, there's qualifications. I believe this falls under that 250-hour rule, but it doesn't mean you have to put the 250 hours in. And remember, you're trying to make your rental property rise to the level of being a trade or business. So in trades and businesses, you often have other people that work for you. Well, for this, their time counts, right? So it's very different than the material participation rules and some of these other things. Definitely talk to a CPA. If you want to see if you qualify for this, again, take all the deductions you are entitled to. It's the name of the game when it comes to keeping your money in your pocket, not overpaying in taxes, even in real estate, right? So that's it, guys. I'm Bette Hochberger, CPA, CGMA, and we will see you next time. Thank you for watching. If you found this helpful, please leave a comment, like, and subscribe. Stay tuned for more tips on growing your business and your wealth. Bye.